There are dozens of ratios to analyze the balance sheet of a bank or an NBFC. But what if I tell you you need only three to judge its true strength? That reveals the asset quality, profitability, and stability. I call it as NIC Framework. Welcome back to the channel. I am Prashant. In today's video, we are going to see NIC Framework, the three key metric to understand the balance sheet of any bank or NBFC. This video is essential for investor or depositor who wants to assess the true strength of the bank or an NBFC. The first metric is NPA, which stands for non-performing asset. In the balance sheet of a bank, the major asset is loan given to the customer, which is the primary source of revenue for the bank. Think, if the borrower stops repaying the loan or even the interest, that's where it becomes the non-performing. That means the money of the bank is stuck. So why do we care for NPA? When the loan become NPA, that means the bank's money got stuck and new lending is not possible, which affects the growth of the bank. Also, the bank needs to create a provision which takes hits on the profitability of the bank. For analyzing NPA, we need two ratios, that is the GNPA and the NNPA. Gross NPA reveals the percentage of NPA out of total loan book. If suppose a bank has lent 100 crores, out of that 100 crores, 10 crores is non-performing. That means 10% of the loan is gross NPA. Net NPA is the delta between the gross NPA and the provisions made out of profit for the NPA. So what is the good ratio? For GNPA, anything between 2 to 5% is good. For NNPA, less than 2% is ideal. We have to analyze the trend of the NPA, if it's rising or decreasing. If it's rising, that's a red flag. After understanding the asset quality of the bank, now it's time to understand how the bank efficiently earns through these loans. That metric we call it as net interest margin or NIM. So what is net interest margin? Net interest margin is nothing but it is a delta between the interest earned on the loans given and the interest paid on the loans borrowed by the bank. If suppose the bank earns 10 crores from the loans given and pays 6 crores to the loans borrowed or deposit taken, that means the bank has earned a net income of 4 crores. But we have to understand the net interest margin. How to calculate the net interest margin? Net interest margin is nothing but net interest divided by the total loan given. That is, in our example, 4 crores is the net interest divided by the 100 crores of the loan given. That means 4% is our net interest margin. Why the NIM is important? NIM is important for the two reasons. Number one, it is an indicator of the profitability. Also, it reveals how the bank handles its competition, how it is pricing its loans on deposits. So what is the good NIM percentage? For banks, it is between 3 to 4%, and for NBFC, it is more than 5% is good and healthy. We have to see the trend of the NIM, whether it is increasing or it is decreasing. The increasing reveals that there is a control over pricing and profitability, and if it is decreasing, it reveals that there is a margin pressure or there is a cost of fund increasing for the bank. So far, we have seen the asset quality, which is revealed by the NPA, and the profitability, which is revealed by the net interest margin. And now, what about the stability? Whether the bank will be stable? That is revealed by the ratio which is called as capital adequacy ratio. What is capital adequacy ratio? Capital adequacy ratio measures how well the bank's own capital can absorb the potential loss. Capital adequacy tells you in simple terms whether the bank can survive the financial stress. Why capital adequacy is important? Capital adequacy is an indicator of the solvency and stability of a bank. Also, it is the cushion for the bank to take further risk in. What is the good capital adequacy ratio? Ideally for bank, anything more than 12% is good. For NBFC, anything above 15% is good. Always watch if the capital adequacy ratio is declining, which reveals that the bank is taking risk without increasing the capital. Remember, numbers tell story and NIC reveals the story behind the balance sheet. If you like NIC Framework, make sure to like and subscribe to the channel. We'll see you in the next video.